Hello, everyone. I'm Mark Kinney, Chief Investment Officer of Newport Private Wealth. In the second quarter update, we'll talk about protecting capital at this stage of the market cycle and how we're successfully finding alternatives to produce income and growth. As a client said recently, I don't understand stock markets anymore. They keep going up in the face of tariffs and trade wars and Brexit and slower economic growth all over the world. He is right to question the sustainability. This past June marked the longest U.S. economic expansion in history, and, depending on who you ask, now the longest bull market on record. As we've stated in previous reports, we, as well as our independent equity managers, are concerned about valuations. Stock prices are now rising faster than corporate earnings. As an extreme example, EdgePoint, our global equity manager, did some analysis that showed 10 companies named here lost $4.5 billion pre-tax last year, and they have no expectation of making profit in the near term. And yet the stock market has valued them at $187 billion. For the record, these are not companies we own. Our independent equity managers own well-managed, proven businesses that can withstand challenging economic times. In recent months, managers have been culling their portfolios and taking some profits, which we think is prudent in an aging market cycle. At the Newport Investment Committee, where big picture asset mix decisions are made, we've reduced our total equity exposure to protect capital. A balanced portfolio now has 40% invested in equities, meaningful enough to participate in the market's rise, but considerably less risky than the 60% or more that you typically see in a balanced portfolio. Bonds have also reached bubble territory. In the second quarter, 10-year bond yields fell to 1.5% from 2% at the start of the year. Falling yields mean a rise in bond prices. As a result, the Canadian bond index is up 6.5% year to date. The strong performance is, in our view, short-term, unsustainable, and dangerous to pursue. Consider that bond investors are now offered a mere 1% of incremental return for moving up the risk curve from 2 years to 30-year terms. While it is true that investors will ultimately be repaid their principal if bonds are held to maturity, in the interim, the price could drop more than 50%. That's a level of decline that would strike fear in the hearts of even the most risk-tolerant equity investors. To mitigate this risk, we've continued to significantly underweight bonds in client portfolios. And for those that we do own, we focused on owning shorter-term issues from high-quality issuers. Our prudence means we've missed some of the upside as stocks and bonds have climbed to precipitous heights. But as I used to tell my teenage children when they're heading out to a party, nothing good happens after midnight. Better to enjoy the party and leave at a reasonable hour than be the last man standing when the police arrive. Or, as our North American equity manager Dennis Sterrett recently wrote, chasing today's rising markets, especially the most fashionable and probably least sustainable components, is just another form of stupidity. You're probably wondering then, is there any place we're finding value? The answer is yes. We continue to find opportunity in private alternative investments. We have a mature, robust, diversified, and growing portfolio of real estate, private mortgages, global infrastructure projects, private debt, which I spoke about last quarter, and private equity. These investments offer diversification away from public markets and have many attractive return features. Let me give you an example of a transaction this past quarter. Park 9 is a 356-unit apartment community in Orlando, Florida. In 2014, we were part of a small group of investors that purchased this property for $29 million. The manager and co-investor with us then began an upgrade program, renovating units to increase the property's value and rental income. This was very successful, and as the property reached peak value, the decision was made to realize our profit. There were multiple bids, and Park 9 was sold this past May for $63 million. This represents a total annualized return of 28.5%. The example illustrates several important aspects of our private investing capabilities. One is access. These investments are highly sought after, hard to access, and illiquid. Some are closed to new investors or require a minimum of $10 million to participate, beyond the reach of even many ultra-high net worth investors. We've developed the capabilities, networks, and structure to make them available to all our clients through our funds, which also provide liquidity. 2 is growth over time. Obviously, returns can be lucrative, especially when these properties are purchased below net asset value, as we seek to do. But as the Park 9 example shows, it takes time to realize on the value creation. 5 years in this case. During this period we owned Park 9, the property's value was appraised annually, not daily as the public market investments are. So the value creation doesn't show up in each quarterly statement. 3 is diversification. From a risk perspective, it's important not to overcommit to any one property or manager. It would be like owning one stock. Park 9 is one of 38 properties we've invested in with this manager. In total, we currently have an interest in more than 30,000 apartment units throughout Canada and the US through a handful of select real estate developers. This year, we will put another $50 million of cash to work in the new fund of a second investment partner with whom we have a long track record. The fund will invest in large-scale Canadian apartment buildings that have been under-maintained. They are located mainly in Toronto and Montreal, cities with very low vacancy rates and high levels of immigration. Finally, income. Park 9 and other multifamily residential properties can generate high levels of income through rents. The average annual cash return is about 7% and can grow to 10% over the life of the property. This creates a good problem. As cash comes back to the fund, we have the task of reinvesting it. Since we won't compromise on our investment criteria, sometimes we need to wait for the right opportunity. This is one reason why our cash levels are high. The other is because at this stage of the economic cycle, cash is also a defensive feature that puts us in a position to take advantage of buying opportunities when they materialize. In closing, on behalf of my colleagues, I want to thank you for your continued trust. As we manage through these interesting times, we are extra vigilant in assessing risks and opportunities to grow your wealth. Have a safe and happy summer, and we look forward to reporting to you again soon.